Our forecast for this fiscal year for GDP growth is 6.9%. It's slightly higher than we were not long ago. And the main reason for that is the recent GDP outcome demonstrated that point that we've been making about robust domestic activity, private consumption and investment activity being quite strong, and a surprise on the positive side as well. So we expect the fiscal deficit to decline over the course of the next few years. That consolidation is expected to be gradual. A large part of that consolidation story is driven by strong revenue performance. I'm sure you're all familiar with the story of strong GST. So we're seeing a lot of the revenue side helping that consolidation path. And India's economy has rebounded fairly robustly following the contraction that occurred during the pandemic year. You can see India's performed quite well relative to other large emerging market economies as well. And this story of rebound has been driven largely by domestic demand, robust domestic demand. Consumption and investment in India has done quite well. As a result of this robust domestic demand, we're seeing that translate into a higher import bill. India does require import capital, and we're seeing that translate into a widening current account deficit. This is to be expected. It's not something that one wouldn't expect when domestic activity is quite robust. And at the same time, the pressure that we've seen all around the world has also translated into an increase in inflation here. Food and fuel, of course, comprising a large part of India's consumer price basket. Inflation has tracked above the RBI's tolerance range for several months now. But as I said, a large part of that is driven by factors on the supply side, food and supply disruptions. Similar to what we've seen everywhere around the world, the central bank in India, the Reserve Bank of India, has stepped in and hiked policy rates over the course of the last 6 months. We've seen approximately 190 basis points worth of rate hikes, and this is an approach that is in line with what we're seeing everywhere around the world as well.
It is good to know going forward that India has some strength also, with debt to GDP having come down, with fiscal space being good, with monetary policy being on the path to moving India towards its expected inflation target or zones. India is in a good place. Having said that, we also should take note of the fact that the debt service is still very high. So in an environment with changes in global interest rates, it's not trivial what the impact of this interest rate movement would be on the fiscal burden through high interest payment. It should also be noted that the Indian economy is very reliant on the banking sector, as many emerging market economies. The banking sector in India has done very well, has improved significantly. There is no major risk as such, but globally, again, the interest rate movement could represent some uncertainty for all major economies, all emerging market economies, in terms of how it affects the financial system and the ability of investors to access low-cost finance. So these present some uncertainties going forward, but overall we are very optimistic about the ability of the economy to withstand the shocks.
If you like the video, do like, comment, share and subscribe.